and we're limiting it. This is time limited in terms of what we're going to be talking about here. Which is the biggest threat? Rate hikes? I don't think we're going to see rate hikes in the Fed, but we could certainly see them signaled, or maybe they just end QE on a dime, or Russia. The risks surrounding Russia, absolutely enormous at the moment, and it's moving pretty quickly. Damian Sassower, Bloomberg Intelligence, joining us now. Bloomberg's Vincent Cignarella, also on deck. Vince, let me start with you. What do you think of the price action right now? What is it signaling? And where does the real threat lie? Is it higher rates? Is it the Fed moving more aggressively? Or is it war in Europe?
I think you're talking about war in Europe right now. That's what's on traders' minds. I think the Fed situation has now moved to the back burner. I know we have the meeting on Wednesday. There's no one who believes that they're going to move. And while there are many who think they're looking at a 50 basis point hike in March, I would think that's very unrealistic. Markets don't expect it, don't think they're going to get it. And there's talk of 5 rate hikes this week. It almost reminds me of the old game show. I can name that tune in 5 notes, and someone has to come up and say they can do it in 4. You know, every time someone says we want 3 rate hikes, somebody comes along and says, I think it's going to be 4. And then you get Jan Heitzes says there's going to be 5. I just think people are just getting ahead of themselves in trying to be the first one, you know, front and center to take credit for something that I just don't think is going to happen.
Vince, you're dating yourself with that.
I know.
mean, I remember it,
Very
but
much
you're
so,
dating
right?
yourself. Hey, Damian, same question to you. Market signal: is it Russia? Do you agree the threat of war, or is it the Fed?
Well, I think it's who you're talking about. Risk to whom, right? If you're talking about risk to you, me, I mean real risk in terms of death, war, destabilization of the global economy, well, then clearly Russia's going to be, my answer to that. But if you're talking about risk to asset valuations, to prices, I still think the Fed takes the cake on that one personally. I mean, look, it's been stimulus driven by central banks, not just the Fed, the ECB, the BOJ, the PBOC, you name it, that's been fueling all that we've seen over the better part of the last 2 years. And look, we're in a very different position this year in January of 2022 than we were last year. Bonds are down, stocks are down, crypto's down, everything's down. How fund managers behave in that type of environment, we could sit here and point our finger at Russia or point our finger at the Fed as the reason why we're here. But the fact is, fund managers that react in very different ways when they're posting losses this early in the year.
Yeah, and how do you think the Fed's going to react to those losses, Damian? You look at what is happening, not just in Europe, not just in the United States, but around the world. The Fed is looking at a significant shift in terms of financial conditions. How is it going to deal with that? It hasn't actually done anything yet. Is the balance of probability that the Fed is going to be more hawkish than the market is pricing in currently, and we've moved very quickly a very long way? Or is the balance of probability, just in terms of managing the risk, that actually the Fed is more dovish than the market anticipates this week?
Well, Guy, you are hitting the nail on the head. I think spreads and equity valuations are going to take a lot of pressure off the Fed over the coming months, specifically if we move in the same direction we're going right now. But, just taking a step back, base effects are going to be enormous in the second half of this year. Inflation is going to come off. It is. And so, how the Fed reacts, whether or not, it's more persistent than their calculus allows them to behave, those are different things. And certainly that will drive the path of policy rates going forward. But for me, yeah, certainly there's an awful lot priced into the market right now. We could see things come off, but watch out for credit spreads, watch out for equity valuations. I think that could do a lot of the Fed's heavy lifting for them in the new year.
Well, credit spreads still relatively well behaved considering the action we're seeing in the equity market, down 9.9% now for the S&P so far this year, so nearing that correction territory. Hey, Vince, along the same kind of lines here, I wonder, what are the chances we get some kind of tradable bounce on Wednesday?
You mean from the Fed? I don't see it, actually. I agree with Damian that inflation is going to come off, but frankly, for all the wrong reasons. Inflation is going to come off because the economy is now slowing. We're seeing this tension in Europe. I mean, most of the traders I talk to a man, actually, they see this as inevitable, that there's going to be some sort of incursion into the Ukraine. That is not positive for equities. It's not positive for risk. It's not positive for growth, and it certainly will be negative for inflation. It puts the Fed in something of a comfortable position and wait and see. They've always been data dependent, so it makes no sense that they'd be moving anytime soon while the world is in turmoil, especially since rates are falling as people are going into treasuries looking for havens. The one place I would start looking that no one is looking at all is watch the housing market. It's the one place the consumer still has cash in his pocket. And if we start to see the housing market roll over, and there's every reason that it can, that's when we're going to see real worries about the U.S. economy.
Vince, I want to come back to kind of what's priced, though, and I appreciate that the housing market is an area that we want to keep an eye on. I'm going to get quite a lot of data on that over the next few days. But what is priced in terms of credit, equities, and the govie market right now? Because I'm looking at a VIX curve that is inverted. Basically, the market is signaling that this is as crazy as it gets, that things calm down after this. We're pricing in a lot of things very quickly. How close are we to the end of that process? If I take a look at the VIX curve, it's maybe signaling that it does come to an end relatively soon.
I don't know that we're there relatively soon. I mean, the markets are in a situation, and this has been going on for a while, where they just get a sniff of something and they immediately price in the end game. I mean, we've seen this when it comes to the virus. You know, every single health official had said by mid-January, the variant's going to be gone and we're going back to normal. We're about a week after mid-January and we're still in it. I think jumping to the conclusion that things are at their worst is a dangerous game. I think there's a lot more worse things to come.
Okay, so Damian, that leads me to the safe haven trade, which also leads me to emerging market equities that have actually held up very well considering the move we've seen in the bond market and the move we've seen in the U.S. equity market. Are we looking at emerging market equities in some respects being a safety trade right now?
No, not at all. No.
Are they going to play catch up at some point?
Absolutely not. No, and the reason for that, Alex, you can't even put them in the same sentences because of the currency risk that's embedded within them. The dollar, for all its it's still the best of the worst, and it's still remains the most resilient of all G7 currencies. But the reality is, when you're converting those equity gains in emerging markets back into dollars, you're going to have quite a bit of volatility there. So no, I wouldn't consider it to be a safe haven. Really, at this point, given where crypto is right now and the fact that any sort of correlation you might have had of looking at Bitcoin and gold and carrying them in the same sentence goes out the door. I mean, gold is really your only safe haven asset outside of the yen and the Swissy in my mind.
So, Vince, before we wrap up, obvious question, yen and the Swissy, how high can they go on this?
High, but I don't think as high as people might imagine. The days of old where the Swiss franc is this neutral country, it's not the most daunting or most reliable asset in the world. Same for Japan. Japan's still got a lot of things going for it, but it also has a lot of negatives going for it. I think, as Damian mentioned, I agree with him completely. EM is definitely not the place to be. If you had to pick a safe haven, I would just say the broad dollar index in general. I wouldn't look for a specific currency.